Hey, so I need to tell you something that a buddy of mine shared with me a few weeks ago, and I haven't been able to stop thinking about it since. He spent over a decade as a revenue agent at the IRS, retired a few years back. We were just hanging out, talking about money stuff the way we do, and I mentioned that I'd been moving some savings around between accounts. Normal thing, right? And he just looked at me and said, "Zai, stop. Let me explain something to you before you accidentally create a problem that doesn't exist." What he told me next, I'm turning into this video, because what he described is something almost nobody knows about, and the people who do know about it usually find out the hard way. There are three specific things you can do with your own money. Legal money, money you already paid taxes on, that will flag your account inside a federal system before any human being ever looks at your file. And the wild part? The flag itself isn't the real danger. The real danger is what most people do the moment they find out the rule exists. That instinct, that gut reaction to protect yourself, is the exact move that turns a routine computer alert into a full federal examination of everything you own. So let's get into it. First, you need to understand how the IRS actually decides who gets audited, because it's not what you think. My buddy explained it to me like this. Every single tax return filed in the country runs through a scoring algorithm called the Discriminant Function System, the DIF. The IRS has never published the formula. It's a secret. What the system does is assign your return a numerical score based on how much it deviates from the statistical norm for people with similar income and similar deductions. The higher your score, the more likely a human examiner gets assigned to your file. Running alongside that is a second system called the UIDIF, the Unreported Income Discriminant Index function, which is specifically hunting for patterns that suggest money that never made it onto a return. Both systems run on every return every year automatically. But here's the part that really got me. The IRS receives approximately 3.5 billion information returns every year. Every W-2, every 1099, every report from your bank, your brokerage, your payment processor. All of it flows into a massive database, and sitting on top of that database is a program called the Automated Underreporter System, the AUR, which my buddy described as the IRS's single most powerful compliance tool. It does one thing: compares what third parties reported about your money to what you reported on your return. When those numbers don't match, it flags you. In fiscal year 2024, that one program generated $7.7 billion in additional tax assessments. Not from audits, from a computer that noticed a number you missed. Okay, now the three transactions. The first one is large cash deposits, specifically anything above $10,000 in a single transaction. Under the Bank Secrecy Act of 1970, your bank is legally required to file what's called a currency transaction report, a CTR, every time that threshold gets crossed. That report goes straight to FinCEN, the Financial Crimes Enforcement Network inside the US Treasury. The bank files it automatically. You don't get notified. You don't sign anything. It just happens. And by itself, a CTR is not an audit trigger. My buddy was clear about that. Most of them go nowhere. The problem shows up when your tax return says $48,000 in income for the year, but your bank records show $90,000 in cash deposits. The AUR system sees that gap. It doesn't know you sold a boat, got an inheritance, moved your own savings. It just sees two different stories, and two different stories generate examinations. The second one is the one that I almost did myself, honestly. It's called structuring, and it's the natural reaction almost everyone has when they first hear about the $10,000 rule. You think, okay, if 10,000 triggers a report, I'll just deposit 9,000. Or you break it up. 9,000 on Monday, 8,500 on Thursday, 9,200 the following week. Seems smart. It is actually a federal crime. Under 31 US Code Section 5324, structuring is illegal even when every single dollar you're depositing is completely clean. Legally earned, legally inherited, legally gifted, doesn't matter. If the intent is to stay below the reporting threshold, the act itself is the offense. My buddy told me the penalties are severe, up to 5 years in federal prison and fines up to $250,000 for amounts under $100,000 in a 12-month period. Above that, up to 10 years. And in both cases, the government can seize the money through civil forfeiture before you've been charged with anything. He told me about a case he worked early in his career. A retired school bus driver, 68 years old, sold a piece of land he'd owned since the 90s. Buyer paid cash, $38,000. The guy had heard somewhere that big deposits caused trouble, so he split it up over a few weeks. 4 deposits, all under $10,000. His money was completely legitimate. He'd owned that land for 30 years, but the bank's compliance software flagged the pattern and filed a suspicious activity report. And here's something most people don't know. Federal law prohibits the bank from telling you when one of those has been filed. It's actually a crime for a bank employee to inform you. So this guy had no idea. By the time everything got sorted out, the legal costs had eaten a significant chunk of what he was trying to protect. He was cleared, but cleared doesn't mean whole. The third transaction is the one my buddy said the IRS catches most consistently, and it's the one almost nobody sees coming. It's called a lifestyle inconsistency. The same systems that score your return and match your information returns also look at the relationship between what you report earning and what the evidence suggests you're actually spending. If your return shows $55,000 in adjusted gross income, but your bank records show $140,000 in deposits flowing through your accounts, that's a discrepancy. If your reported income doesn't logically support your mortgage, your car payments, your visible financial activity, the systems flag it. My buddy called it indirect income reconstruction. The IRS infers unreported income from the gap between what you say you earn and what the paper trail suggests you're doing with money. No tip needed, no whistleblower, just your numbers telling two different stories. Here's the thing though, and this is what my buddy really wanted me to take away from that conversation. The protection against all three of these costs you nothing except a few minutes. Every time you make a deposit over a few $1,000s, write one sentence about where it came from. Sold my 2021 truck to Marcus Webb, March 12th, $18,500 cash. Received inheritance distribution from my father's estate, April 3rd, $27,000. Received a personal gift from my sister, no expectation of repayment, $15,000. One sentence. Attach whatever documentation exists, a bill of sale, a gift letter, an estate settlement document, a transfer confirmation. Put it in a folder. That folder is your entire defense if anyone ever questions a deposit from 3 years ago. If a teller asks about a large deposit, answer in one sentence and hand them the documentation. Don't explain your whole financial history, and don't say anything that sounds like you're trying to manage what gets reported. My buddy told me those exact words can end up in a suspicious activity report narrative. And if you ever get correspondence from the IRS, FinCEN, or the Department of Justice about your banking activity, stop. Do not answer questions. Do not try to explain yourself on the spot. 5 words. I would like an attorney. That's not guilt. That's the correct response to that situation. And my buddy said he's seen people talk themselves into investigations they never would have faced if they just made that one call first. Look, the system I just described isn't designed to catch regular people who made an honest mistake about how to deposit their own money. It's designed to catch financial crime. But the algorithm doesn't know the difference between someone laundering money and someone who got bad advice from a neighbor. It sees patterns. Your job is to make sure your patterns come with clean explanations attached. The $10,000 threshold hasn't changed since 1970. What has changed is how sophisticated these matching systems are and how much data they now have access to. 3.5 billion information returns matched automatically against every return filed in the country every single year. You're already in that system. The only question is whether your paperwork tells the same story your bank records do. If it does, you're fine. If it doesn't, you now know what to fix. Drop a comment. Has a teller ever questioned you about a large deposit? Have you ever gotten an unexpected notice? Tell me what happened. I read all of them, and the situations that come up the most become the next video.